You've probably heard about the Analyst Academy from Fundamental Edge by now. So instead of repeating the basics, let's talk a minute about what the Academy is and is not. The Analyst Academy is a practical course on the tools and skill sets required to succeed in the buy-side analyst seat. The instructors have experience from firms such as Maverick Capital, D. Shaw, and Citadel. But what is the Academy not? It is not a course on stock picking. It is a rigorous guide to learning and process. It is not a guide to pod shop investing. The Academy attracts a wide range of equity investors, from multi-managers to long-only to family offices. Rather than teaching a particular style, Fundamental Edge equips learners with the essential skills required to hit the ground running and support their PM. It is not a financial modeling course. Modeling is, of course, part of the curriculum and plays a central role, but the Academy is more than that. It teaches idea generation, thesis communication, and how to add value as an analyst. To learn more and access a 10% discount code, go to fundamentaledge.com/YAVP, or just see the link in the show notes. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on the founder of HX Research.
Founder, CEO, editor-in-chief, you name it.
There we go. Enrique, how's it going?
It's good. I'm going to apologize very quickly. I was traveling for a month and just got back to Connecticut. And if I sound like a frog, it's because my allergies are literally next level. So, I'm usually not this deep voiced as I am right now, but this is where we got me today.
Deeper voice is actually perfect for, I say radio, for audio. That's what you're looking for. People can be like, who's that handsome man that Andrew's in?
Yeah, exactly. I get my Tom Selleck vibes going on or something.
I'm excited to dive into today's topic, which is, I'd say, one of the most popular not under the radar, but the companies under the radar, companies I know of among value investors. But before we get there, let me just start the pod the way I do every podcast. That's with a quick disclaimer that nothing on this podcast is investing advice. That's always true, but I'll say particularly true today because we're talking about a post-bankruptcy stock that is traded. Currently, it's only traded OTC. So everyone should just remember, less liquidity, increased risk, all of those things. So please, this isn't financial advice, consult a financial advisor, all of that stuff. Enrique, the stock we're talking about today is Talon Energy. You and I are sitting here talking. It worked out well. We're talking May 14th, and they reported earnings last night. So I was literally just finishing up the earnings call before we talked. But I will say this has been one of the most popular names I know of among value investors for the past 12 months. They've been dead on right because the stock has basically doubled since it emerged from bankruptcy. Yep. I've rambled. I'll pause there and turn it over to you. What is Talon Energy and why are they so interesting?
Okay, well, let me give you a little backdrop too. So, because this is important. I mean, and I think you know a lot of this. So, my background is I got into the hedge fund business in 1996, became a portfolio manager in 97, and then managed money for roughly 30 years. I founded several funds, co-founded some other funds. The reason this is relevant is one of the very first areas that I got involved in was the utility area. There were a bunch of analysts at Goldman Sachs, led by a guy named John Rowley, who unfortunately passed, another guy named John Rajewski, who unfortunately passed, and my buddy Greg Gordon. But I got an introduction to them, and what they showed me was that there are some really incredible opportunities that emerge in the utility industry around bankruptcies. And the reason that is that fundamentally utilities are set up to make money, right? They're built to be profitable. The only reason a utility goes bankrupt is because of the debt load that's put on top of it. So, and you're way too young to remember any of these names, but maybe some of the people out there, we did something similar to what we're doing here with Talon with Niagara Mohawk, which was an upstate New York utility 25 years ago. There was one called Bangor Hydroelectric, actually Pacific Gas and Electric, PCG. Every 5 years, 3 to 5 years, the market serves up these opportunities.
I laughed when you said I was too young for them because I covered utilities in a prior life, but then you threw those names out. I was like, nope, never heard of these guys.
Yeah.
Absolutely right.
Bangor especially. But so basically what I learned is whenever a utility goes bankrupt or is about to go bankrupt, you should get very interested. You may not want to buy it immediately. You want it to play through a little bit, but this just happened with PCG and the forest fires. So let's go to the story of Talon. This is what Talon is. Okay. Talent is an independent power producer that is fully independent and has no electrical load that is guaranteed to go anywhere. So they own generation assets. As of today, and this is, when I keep on looking over here, I'm going to go to a whole bunch of presentations that are fresh here. As of today, they own about 10, because they just completed the sale. They own 10.6 megawatts of power generation, which is primarily composed. 2.2 megawatts of that is the Susquehanna nuclear plant. Now let's go back to a little bit of history. There is
it megawatts? It's a little bigger than that, right?
That's the gigawatts. I'm reading off the thing. It's megawatt hours, which translates into gigawatts.
Okay, perfect.
Okay, yeah. Sorry, it's like, and then we.
No, I was just like, wow, that's. I've done a lot of work in this company. They're a lot smaller than I thought.
No. Sorry, I they listed as megawatt hours, which actually equals gigawatts. So, the history of the company, relatively simple. There was an old utility called Pennsylvania Power and Light, ticker PPL, which we've traded for 20 years. PPL went out and took their generation assets and they combined them in a transaction with a private equity created entity that was called Riverstone. This was done back in 2015. The combined entity then went out and took on a lot of debt. And what happened is we went into the late 20 teens, I guess is what we would call it. Power prices in this country really moved a lot lower. We saw a lot of gas power coming on. You begin to see a little bit of the renewables coming on. Just power prices went very low. And as a result of that, the company never was not profitable. They just had way too much debt. So they didn't have the profitability to service the debt. So the company went into bankruptcy, actually went into Chapter 11 in May of 2022, and they emerged in May of 2023. Now, the process here, and I'm not saying that there was anything done wrong or illicit or whatever, but it was a very accelerated process. They did go out and take bids for the assets, but the process, the way it was run, very much appeared like the company really wanted to emerge as a standalone entity, and basically be in a position to take advantage of these assets, but with a better balance sheet. And we could get into a lot of subtleties about what the individual bankruptcy court things they did and all that. But net, the company came out and was publicly traded beginning in May of 2023, and the original share price here in May of 2023. So, by the way, we're just about a year here. The original share price was about. I actually show the first trade at 44 on June 6th at 44.50. Okay, now at the time they had about 13 gigawatts. They had a data center business. They had a lawsuit with PPL around some other assets in Montana. There was this whole bunch of stuff, and they had about 2.6 billion of net debt. And remember, this is listed OTC. And one thing I want to go back to, and I'm sorry, it sounds like I'm going to lose my voice, but I'm doing my best here. You know, when you said OTC, it's very interesting because OTC, the listed exchanges, the NASDAQ and the New York Stock Exchange, have these bare minimums of things that you have to be able, representations you have to be able to make about your liquidity, your net equity, etc. We both know there's all kinds of ridiculous things that are listed on the NYSE and the NASDAQ. But what happens is, having gone bankrupt very recently is something that definitely cannot put you on the NYSE or the NASDAQ. So while you said that it has less liquidity, and that is absolutely true, I don't know that I would always agree that it has less risk. One of the most interesting spots to find is if you can find an OTC listed company post-bankruptcy that is actually in just fine shape, but they're not able to uplist yet because they haven't had enough time, enough quarters of retained earnings, all these other things. So the company comes out of bankruptcy and it's got all these little pieces. I'm going to cut to the chase and tell you what they got now and why it's important. Okay. Today, again, we've got the 10 gigawatts. There's 2.3 gigawatts of the of the Susquehanna plant, of which they own 90%. The rest is a mix of natural gas, a little bit of coal. The vast majority of this, 98% of it, is in the PJM market. That's the Pennsylvania, Jersey, Maryland area. And what's interesting about this is these assets are completely free to do whatever they want them to do. And let's take a step back, and I'm going to go through some other big macro stuff right here as well. And a lot of this will seem quite obvious when I say it, but I don't think people really understand it. We have made almost no investment in real net power generation in this country for decades. While there has been an expansion, a tremendous amount of investment in solar and hydro, both of those have their own issues. But at the same time, we've seen coal, and we've even seen nukes come off. We saw Indian Point, which is one of the greatest tragedies of economic and energy policy. The fact that the Indian Point plant here in New York was taken offline is just like absolutely insanity. But what you've seen is net megawatt additions in this country have been essentially flattish, low single digit growth as we add these renewables, which remember are, and I know a lot of the people on this podcast probably know this, those are intermittent, right? It's not always sunny. It's not always the wind isn't always blowing.
It's not always sunny. There's 12 hours a day when it's not sunny. Yeah.
There's 12 hours a day when it's not sunny, and it's very expensive. And again, I'm going to go down a couple of different rabbit holes here. When people go out and say this, well, renewables are now cheaper than everything else. Well, they're not counting the batteries that you actually have to build to be able to store it, nor are they counting building the transmission that you need to build it. But what's happening now is with hyperscalers, data centers, et cetera, we're seeing a material acceleration in the demand for power. Now, what does the material acceleration mean? That means that we're going from, 0.5, 1%, 2% growth to perhaps 2, 3, 4% growth. So these are not crazy numbers. But what happens is when you're running AI, and again, there's a lot of little subtleties in this math. There is a claim that running artificial intelligence algorithms and all that is 10 to 50 times more power intensive than running what you would traditionally run in a data center. I don't know if I really believe quite that number. And there's an entirely other argument about people saying, well, the chips will get more efficient, but as the chips get more efficient, we're just going to use more chips. Like there's no limit to this. But let's just take a very simple curve. We've got a 1% growth in supply, and we've got a 2, 3, 4% growth in demand. The problem in power markets is that when power prices go up, they go up asymptotically, or it's a version of exponentially. It's not that all of a sudden people say, well, the power price was 50 and now it's 75. I'm just going to stop using my lights, or I'm going to just stop my factory. There will be power load that will come off and all that, but we are sitting in front of, and I think we're in the second inning of what is going to be a decades-long power crisis in this country. And it's the simplest thing in the world. We can't build enough renewables. The renewables aren't intermittent. You can't get new nukes built. We'll go more to that. You can't even barely get new gas built. People are trying to take off coal. And as we go into artificial intelligence, data centers, et cetera, demand is accelerating, demographic growth is good enough, et cetera. Very, very simple equation. So what's fascinating about Talon, okay, and I'm going to cut right to the chase because we could go through, all these things they did. They went out and they had a data center business that they built next to the nuke. It was called Cumulus. They just took that data center business and they sold it to Amazon. They got $650 million of proceeds, $371 million of net proceeds. When Amazon bought it, Amazon also committed to expanding it by another 50%. But more importantly, Amazon contracted for several decades to buy the power from the nuke, because they're basically co-located, the data center of the nuke, to buy the power at $70 a megawatt hour. Right now, PJM is clearing at about $45 a megawatt hour. Okay. So where we sit today, after all these things that have been done, this is what Talon looks like. And it's very important. This is where the rubber hits the road. There are 58 million shares outstanding. The stock this morning was trading at 106.95. It's up a couple dollars. I'm going to put 106.95 in my model here. That means we have a market cap of $6.2 billion. The net debt currently, and literally this is from their presentation that came out last night, is $845 million. That means we have an enterprise value of $7 billion, 7048. Okay. Now I want to go through three things to think about when we think about this. The first, and I know a lot of investors who are smart money and critical will look at what I'm about to say and be like, well, yeah, sure, that's true, but does it really matter? But I think it does. Susquehanna, when they built it and finished it in 1984, cost $8 billion to build. Inflation adjusted, that would be $24 billion today.
If I can add, like, that's your inflation adjusted number, but I don't think that's your regulatory inflation adjusted number, right? Like, go look at what any modern, am I thinking about that correctly? Because go look at what any modern power plant, 15 extra, like, time value, the regulatory, everything. Go ahead.
I got a better number. Southern Company literally just finished building a nuke that's a newer nuke, but slightly smaller, and they spent $30 billion on it. Okay. So, like, sometimes I am a big fan of Charlie Munger and Warren Buffett for what I call just plain fucking common sense. Here's the reality. I've got an enterprise value of $7 billion. I've got a nuke that cost $8 billion to build 30, 40 years ago. Inflation adjusted, et cetera, would cost 15 to 30 billion. Southern Company just built one for 30 billion. This thing is worth more than 8 billion. Okay. It's probably worth double, because if I'm one of these other companies, if I'm Constellation, if I'm Vistra, if I'm PSENG, and I'm looking to expand capacity, here's what I could do. I could go out and try to build a nuke. Well, Southern, it just took them 2 decades and double what they thought. Or I could go out and offer 15 billion for Talon, and I have a functioning nuke the very next day. So again, I know people will look and say, well, private market value, replacement value. I think it's very, very real here. But let's go to the numbers too. Let's go to a couple other things. So right now, the midpoint of the range of the EBITDA is 700 million. Okay. The new guidance is 600 to 800 million of EBITDA. And we don't need to go through operating cash flow versus EBITDA AOI. EBITDA is a good proxy here. It'll work just fine. Okay. 700 million. That means that today this trades at 10 times EV to EBITDA. If I look at Constellation, which is very clearly the leader, Constellation trades at, I'm pulling it up on my Bloomberg here. Constellation trades at 17 times EV to EBITDA. Okay. Vistra, which has lower quality assets, trades at also 10 times EV to EBITDA. Vistra bought another company, ENGH, for 11 times EV to EBITDA. But so when we look at it, one could say, you could take this 2 ways. You could go and say, okay, at 10 times EV, so we know this replacement value, strategic value. At 10 times EV to EBITDA, perhaps this thing is fairly valued because that's where Vistra is. ENGH traded at 11 times EV to EBITDA. But let's talk about what happens to power prices next. Right now, the company, and I'm going to get these numbers slightly wrong because I got like 6 million tabs open here. So I'm going to try to get the press release. But right now, for 2024, they are 88% sold forward. For 2025, they are 34% sold forward. And for 2026, they are 17% sold forward. So that means they have very large exposure to higher power prices. They say that for 2026, every $10 of megawatt hour addition would equal 335 million of EBITDA. So let's have some fun with math. We know PJM is trading at 45. We know Amazon gave them 70. Okay, Amazon's not a dumb buyer. That's $25. That is 2.5335 times. That's 837 million of EBITDA on top of the 700 million of EBITDA that they're doing here. Now, perhaps I'm doing blue sky, right? Because I'm saying, what if the whole market trades? But if I go in and I plug in 1.5 billion of EBITDA, the stock's trading at 5 times. If I put a 10 multiple on that, you're looking at, you're looking at a stock price that's, sorry, let me just redo this formula here. If I put a 10 multiple on it, you're looking at a stock price of 244. If I put Constellation's multiple, God forbid, 17 times, you're looking at a stock price of 425. The stock's at 105. I would argue that Talon is actually better than Constellation in multiple ways. Number one, they are much more exposed to higher power prices. And we're going to go to what if power prices go the other way in a second. But the upside here to this is an IPP play. It is the greatest and purest upside. Number two, their balance sheet is absolutely incredible. They've got $845 million of net debt. They've got $700 million at the midpoint. They're at 1.2 times net debt to EBITDA. They said that they would go to 3.5 times. Right now, they have $1 billion buyback that's out there. That's on 6 million shares. So we're talking 16% of the shares outstanding. What's more, if they went to 3.5 times net debt to EBITDA, I think it could go, it would be close to 26% of the total shares. Number three, go ahead.
Oh, I was just I've never seen a company say, hey, and they've been consistently saying this, say, hey, our leverage target is 3.5 times and we're roughly 1 times. I've never seen that big of a discrepancy before. And I've never seen it so big where they said on the call last night, they're like, hey, if we did our entire buyback, we still wouldn't be at our leverage target. Like, I've never seen anything like this. And as you have said, these guys generate a ton of cash flow. So it's not like they'd get their entire buyback tomorrow. By the time they did this, they generate so much cash flow, like they'd be way under their leverage target still. It's really pretty crazy.
There's a quirk here. And this gets back to where I started my story, not to just show that I'm old and that I've been doing this shit for a long time. I started my story because with my discussion of Niagara, Mohawk, and Bangor Hydroelectric is because there's a quirk here with utilities, OTC markets, etc. So, I think a lot of what's happening here, remember, the vast majority of utility natural buyers are mutual funds, income funds, etc. They cannot buy an OTC stock. They cannot buy a stock that doesn't have a dividend. Okay. So those buyers are not there. The company itself, as part of the uplisting and all these other, machinations that need to happen out of bankruptcy, they've had to be slow walking the uplisting, the buyback, etc. So, what you found here is you've actually found this like kind of quirk in the financial system, going right into what I think will be, this incredible power cycle. And let me share just a couple of other things here. If you go back and actually look at the chart of PPL, you can pull this one up. This one goes back far enough, and go back and look at what happened in 06, 07. That's the last time we went into a power cycle. PPL, which had rallied during the internet bubble, went from 10 to 50. Okay. Now it didn't stay at 50. It went from 50 back down to 25 after we went through the power cycle. But I don't think this power cycle is going to go any quicker. So that's a 5-bagger. This stock so far is a 2-bagger. Remember, every 5-bagger has to be a 2-bagger first. Okay. That's point number one. Point number two, and again, and just so everyone knows, I have a free report. So I run a research firm, an investment newsletter called HX Research. This is where I put in the plug, but it's actually very purposeful. We don't give out free ideas, but this is one we chose to give out free. We actually have, if you go to daily.hxresearch.net, we have a report that goes out and walks.
There will be a link in the show notes for people who want to go see that. Yeah. So we'll make sure there's access to that.
And it has and just so you know, our newsletter is not written for Wall Street professionals. It's written for ordinary people. So there's a lot of like very ordinary language. Like it's written so your uncle could understand it, not a guy who runs a hedge fund. But by the way, the work that underlies it is the same work that I did in all my hedge funds. So one of the other quirks with this thing is in the very inappropriately named Inflation Reduction Act. What they did do is they put a floor, a tax credit floor underneath nuclear generation prices. That floor where it sits today is at about $42. Susquehanna's costs are at about $22. So this is just literally insane. Is the company right now can earn no less than $20 per megawatt hour out of this asset. They have basically, I won't say unlimited upside, but they have huge exposure to the upside. They have this incredible unlevered balance sheet, and this is going to come back. They're going to uplist the stock. It's going to be listed on the NYSE. You can go through the press releases and you'll see they're doing all these steps. I don't know when that happens. It could happen next week. It could happen next month. I actually don't care. But this is going to kind of get to where I think this eventually goes. I don't think this is a publicly traded company in 12, 18 months. I think that the minute that it uplists, you're going to see Constellation, you're going to see Vistra, you're going to see Southern, you're going to see PSE&G. They're going to go. And if I was on the board of those companies, this is what I would do. I would go and I would say, okay, to build this capacity would cost me $30 billion and take me 20 years. I'll pay $15 billion for the damn thing. I have the capacity in 6 months. Okay. It's completely unhedged capacity. And by the way, when we talk about, what would be the dilution of that, even if I take Southern, which is a more regulated utility, Southern trades at 13 times EV to EBITDA. So if Southern came in and paid stock with the synergies, all this, they could pay double the price. So I don't even think it's gonna be around.
Brett Coffrin, founder and lead trainer of Fundamental Edge, barely remembers his first year as a hedge fund analyst. Most of that year was spent in a blind panic. Was his research any good? Was he learning fast enough? What did his PM really want from him? Trading on the buy side was non-existent 15 years ago when Brett was a new analyst at Maverick. Then he actually got demoted. Then he worked harder, found mentors, and asked for uncomfortable feedback. Eventually, he turned it around, learning by osmosis from the talented people around him, and rose to managing director. But is this the best way to develop talent? Brett doesn't think so, and that's why he founded Fundamental Edge. The Fundamental Edge Analyst Academy provides students with the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. Lose the panic and fast-track your career on the buy side. Find out more info about their next cohort at fundamentaledge.com/YAFP. Or just see a link in the show notes. Southern isn't Southern all regulated? Would they move into unregulated? Am I misremembering that?
I believe they are all regulated. I do believe they could move into the unregulated if they wanted to.
It doesn't change the underlying thesis. I agree with you.
Yeah,
when you said Southern,
PSE&G,
I think they're completely regulated. Yeah,
PSE&G is a better example where it's a combination of regulated and unregulated. But I'm going to tell you, I'm going to give you something else here. Like this power crisis that's coming, and when I say this isn't doom and gloom, like go out and buy gold kind of thing. This is just very simple fucking math. The demand and supply are going to move in a way that we're going to have a shortage of power. And when prices go up, they don't go from 45 to 50. At times they go from 45 to 245. And we will not be able to react quick enough. This is an extended power cycle. It will go on years. I will also tell you that right now, when you look at the hyperscalers, when you look at Amazon, you look at Microsoft, you look at Meta, you look at Google, they all understand this. So I have a piece of data. I can't share where I got the piece of data from, but it was a conversation with a very large regulated utility that has exposure to the largest area of data centers in the country. They said that if they had the generation tomorrow, it would still take 3 years to build the transmission to get the generation to where they needed it. So that means your only choice is you have to build your data centers next to the actual generation. So the deal that they did with Amazon, that Talon did with Amazon, is called a behind the meter deal. There's literally no meter. It just goes straight into it. I believe, and I truly believe this, that sometime in the next 12, 18, 36 months, you are going to see a major company, Microsoft or Amazon, come in and make a bid for Constellation, make a bid for Vistra. I don't know that they're going to make a bid for Talon because it doesn't really move the needle. But my point is, this is one of the rarest assets in the world. It has no analyst coverage, great balance sheet, huge earnings upside. And again, you say people are talking about it, value guys, but what all the value guys have done, and I have a very different strategy. I do a lot of eclectic stuff, but I also do a lot of growth. All the value guys are looking at this stock and say, I can't buy this stock. It just went from 50 to 100. By the way, since we recommended it in my paid newsletter in February, it's up 60%. So everyone goes, I can't buy the damn stock. I'm the opposite. I'm like, okay, you know what you do in that situation is you buy a quarter, a third, a half of what you would want to own at 60, 70, 80. And then if you're right, you still made money on that quarter or half. And if you're wrong about the tactical timing, you're freaking happy because you get to buy in the stock. Yep. So
on just the stock being up, I find one of the hardest things to do is to buy a stock that's been face ripping, especially because I know some of the people who were part of the emergence group here, who backs out the emergence. I know them, and they were pounding the table in the 40s and 50s. And I know people who are pounding the table like you in the 60s 4 months ago. It's one of the hardest things to do. But as you said, like, the execution here has been unbelievable. Selling the Amazon, like people weren't even factoring in value for Amazon. And even the bulls who I knew who were like, oh, $10, they did not see how big the Amazon, and that says nothing to the contract. But B, like you've mentioned, look, I've got this in my thing just to remind in my spreadsheet, just to remind myself. Over the past 6 months, okay, Talon's doubled, great. CEG doubled, VST doubled. Like it's not like you've had, hey, here's a bankrupt. You'll see a bankrupt company. It emerges at 5 times, peers trade at 10 times, it trades to 9 times. You missed it. Here it's, hey, this emerged at, let's call it 8 times to be fine, and peers traded at 12. All the peers went to 20, and this is traded up to 14. So it's more industry move than this specific asset move. I'll let you continue because I've really enjoyed hearing you just walk through the story without.
Yeah, no, look, there's a whole bunch of things. And remember, every value stock that went up 5 or 10-fold went up 2-fold first. Right. So let's just call it a value stock. Like screw it, call it a growth stock. Let's call it a value stock. If there are people that make 5-baggers in value stocks. Every single time they make a 5-bagger in a value stock, you know what the stock did first? It went from 50 to 100. So, I think that's a key. That's just a basic human psychology thing you have to get over. The other thing here too, I think that the upside to earnings here, if this were just, okay, power prices are going to be stable at $40, $50 a megawatt hour. The asset trades a little cheap, 20, 30% discount to, some of the others. It might get bought. It would be a really good story. Okay. It'd be a really nice story. That's not what we're talking about. Okay. That Amazon deal buying a major amount of power at $70 a megawatt hour. And I will also tell you, there is no single power producer, I believe, in the country that has this much available clean green energy in the next 3-4 years that's out there. And remember, Microsoft and Google, they're going to want the green energy. And you mentioned the Amazon thing, the ERCOT sale. The ERCOT sale went off. They sold a bunch of gas powered generation into the Texas market. That's ERCOT. They sold it at 10 times EV to EBITDA. They did the refinancing. I mean, these guys are just nailing it every single step of the way. So, look, what could go wrong? Well, the first thing for people who aren't very educated about this, and I don't mean that as insult, they say, well, there could be a nuke accident. We could go through, in the history of nuclear accidents, there have been 35 people that have died. There are 150 people that die in wind every single year. I mean,
nuke accident is like, if you're listing the risks, yes, that is a risk. There's no doubt about it. But one of the things I've come to appreciate is like, whenever you're buying something, like there is these tail risk, right? Like, you could say the same thing about CEG. There could be a nuke accident, but you could say the same thing. Like, I've invested in refiners before. Refiners are much more likely to have a burn the plant down accident, a turnaround mishap where the plant shut down for 6 months, much more likely than a nuke to have it. You go by GM, guess what? The plant there is probably more likely to burn down or have an issue than a nuke these days because nukes are so regulated. So I'm not saying that's not a risk, but if you were like, I am not buying a nuclear power producer because I am worried about nuclear risk, and that was the difference between you buying and not buying, I'd say, hey, you're probably overweighting the tails a little too much here.
And you're just bad at math and history, to be honest. Like, I'm a math guy. Like, I can look at, when you look at actually the downtime of the U.S. nuclear fleet and the actual math behind every single nuclear accident that's happened, by not buying it, you are making an extremely, extremely low probability bet. That's how I kind of look at those things, right? It's that's what I'm saying. If you're not buying for that, you're
you're lighting an extremely low probability thing, and you cannot believe the story or not. But if that's the breaking point, you're really overweighting those tails, I would say.
And so, the other thing that would keep me up at night, and it doesn't, nuke accident, perhaps there's some issue with the capacity, but they've not had any issues with this plant pretty much ever. What does the company do with all the cash? I mean, what happens when they go to net cash positive? All of that. They've shown themselves to be incredibly responsible. I mean, I'll tell you,
M&A, you mentioned everyone I know thinks the end game is SEG acquires them, right? Like that is the end game. And I want to go back to, you discussed that earlier. I want to go back to that in a second, but let me take the opposite risk. They were asking the call. These guys are going to be generating earnings. Every power plant, every power producer wants to get bigger. What if you go the other way? Like, is there a risk of them going and, now that they've got the ERCOT done, what if they paid 30 times for another smaller nuke? I don't know where they'd buy it, but what if they went on a buying spree, right? Is there risk of capital allocation? This management team says, hey, we've been executing like crazy. Why don't we start growing this story?
We haven't seen it from them so far. Well, so first off, they've never talked about doing it. We haven't seen it. There's nothing available for sale, and they're too small to go after any of the bigger things. So yes, it sits there as a theoretical risk, but I put it very similar to the theoretical risk that I put, on a nuclear accident. To me, the biggest shame about this is I think the stock gets bought at 150, 200, when if we just let it go across the next 5 years and let them buy back a shit ton of stock and let the power prices throw through, this could be a $200, $300, $400 stock. That's the risk to me.
On the M&A risk, this is OTC traded, so they don't have SEC filings yet. They don't have any of the great disclosures. As far as I can tell, none of the Backstop Group has really sold any of their shares. And the Backstop Group was a very concentrated group of very sophisticated investors. Like I would just say, I think the company knows who controls them. And as long as that Backstop Group is for the most part in there, they could do stuff without diluting the shareholders, right? But the Backstop Group has board seats as well. I think it's going to be very difficult for them to get M&A over the finish line with a group of sophisticated.
You're saying for them to go and buy something else.
Yeah. I think it'd be very difficult for them to be like, we're going to buy something for 30, because that Backstop Group, they've got a big winner here and they've got a lot of money. I think they're going to want to say, let's not.
The biggest challenge at the moment, but I want to say this, the biggest challenge at the moment right now is a trading challenge, and I call it the NVIDIA challenge. Okay. Go back to NVIDIA, and we wrote a lot about this at the time, back in February and March. And, and I combine, I'm multidisciplinary. So, entry points matter. Tactical trading matters. And where it really matters too. I mean, we'd all love to say, I'll just buy it and I throw it in a box and I don't look at it again for 5 years. First off, if you're running money professionally, that's a good way to get fired. Second, if you're just a human being, there's very few human beings that can do that. So, NVIDIA back in February, March, and NVIDIA is awesome and their earnings have gone up a gajillion percent and all that. The stock was, 20, 30% extended from its 50-day moving average. What happens is when stocks get that extended from their moving averages, they do retrace, they consolidate. Usually they don't consolidate by going flat. They consolidate with a lot of chop. That's exactly what NVIDIA has done. The 50-day moving average here is $95. But, again, we're talking about a utility here. So if the stock tomorrow went from 107 to 93.83, you're talking about an 11% return. Who cares, man? Like, we're not playing for 10% here. We're playing for 50, 100, 200%. So I think that you do need to tactically enter the trade at this point. And I'll give you this one last piece. Away from the M&A, we have not even started the positive earnings revisions as a result of the power crisis that's facing this country. Okay. I don't know when that's going to start. It may start this summer. It's more likely to start next summer. But when that starts, these things are just going to go ballistic. And when people talk about AI stocks, I'm going to make a comparison here with NVIDIA because it's important. You know what NVIDIA is doing now that they're in the secondary market? NVIDIA's chips are selling for double what you could buy them from NVIDIA, but NVIDIA doesn't have any chips. So you know what NVIDIA is doing? They're building more fabs to build more chips. Do you know what all the competitors of NVIDIA are doing? They're building more fabs to build more chips. So eventually, no matter what the demand is for artificial intelligence chips, there's going to be a lot of supply. You know what ain't happening here? they ain't building any more new nukes anytime soon. So I think when we talk about an AI play, this is the best AI play out there, because you have this incredible combination of value, asset value plus growth, and the growth hasn't even kicked in. So, I think it's really, really unique situation.
Let me jump. So let's stick on AI. And again, you touched on this earlier, but I think one of the worries right now is, look, for a lot of investors, this became clear kind of late last year. For a lot of, it started to get a lot of mainstream coverage. I mean, demand is through the roof. There's this great chart where PJM for years had been forecasting flat demand for, the next 10 years, maybe 1% growth. And over the past 6 months, like, they hadn't been able to take up their demand forecasts enough. And if you read Talon's Q1 earnings calls, they actually go through this well. They say, look, for years, this was, we had, as you laid out, we had the green stuff coming online. We had solar, we had wind, nukes were shutting down, like, because of energy efficiency, deindustrial, like, we just weren't seeing a lot of demand growth. And all of a sudden we've got this insane amount of demand growth. It's true boom times. I guess my question I want to ask is, what if we're getting ahead of ourselves, right? What if AI hits a wall, or all of a sudden all these companies who, AI, it's a huge data consumer, but one of the reasons we haven't seen energy growth over the last 20 to 30 years is because everything got a lot more energy efficient. What if we start seeing all these AI plays, whether it's because of the manufacturing or because AI gets so smart, it says, oh, here's how we can, generate 20% of energy demand. What if all of a sudden we see it hit a wall and it reverses? Aren't we in a mammoth oversupply case there? Or does that really break the thesis?
No, I mean, your thesis about energy efficiency, the energy efficiency of semiconductor chips has increased by 1,000% across the last 15 years, and we are using 10,000% more energy from semiconductor chips than we were 10 years ago. That was my point earlier. Does that make sense? I'm making those numbers up, but you get my point. The chips are getting a lot more efficient and all that. But you actually brought up some points that I didn't. Because there's two other trends that are there. First off, EV and hybrid. That energy has to come from somewhere, okay? And it will continue to expand. I know people are soured on EV right now, but that is a wave that's going to continue. And the other thing is the reshoring of industrialization, which I will say this, no matter what happens politically, and I will give credit to both Trump and Biden, which me just saying those words kind of gives me the icks, but both of them have done a lot to actually work to bring back industrialization in this country. So before we even get to data centers and AI, we've got electric vehicles, we've got reshoring and all that. So I really struggle. My best case scenario is that power prices go up, but not a crazy amount. That's my best case scenario. Look, we get a massive recession, maybe, but it's hard to put in there. I mean, again, COVID's not a good example, because I was going to say COVID power consumption actually went up because all of a sudden everyone was using their computers all day long. So,
I agree. Let me just a little bit more on the AI. I guess the other side of the risk would be right now, like, there is this crazy rush to invest in AI demand, right? Like, and it does seem pretty clear it's going to be huge, but I don't think many people have found a lot of revenue use cases for AI. And I guess my worry would be back in the early 2000s, right? It was clear data usage was just going to be off the charts. Fiber was the future. Everyone was building insane amounts of fiber. And then you have the dot-com crash happens, and we were so overbuilt on fiber, right? Yep. What if we run into a scenario where everybody's going like crazy to invest in AI demand right now, and then 9 months from now, NVIDIA says, hey, we're seeing our leading edge consumers pull back because there's no revenue. And all of a sudden, all the AI startups are bankrupt. And that wouldn't impact the current demand, because I doubt AI and data computing. But you could see like this huge increase in demand kind of level off. Does that make sense?
So your fiber example that you just used is, I wrote in a note about NVIDIA in March, and I actually do think that's exactly what happens in the chips side on artificial intelligence. I think prices collapse. I think, the fiber example is a perfect example. We're going to get out over our skis. It still doesn't change the Talon example. That's the thing with the thesis.
Let me move to the next.
Yeah, if we want to talk NVIDIA, I agree with you. I actually went because the other thing that I did in the late 90s in utilities, in addition to bankrupt utilities, I don't know if you remember this, Montana Power and Light, where they had all these fiber overbuilds, and people were saying, oh, well, if we take the fiber that we build here, and there's what were the companies? Gosh, I'm trying to remember. There were like 3 or 4 fiber companies, Global Crossing, all of this. We owned all of these, and then what we would do is we buy the utility, we'd hedge out the fiber side, all this kind of stuff. So we've seen it, and I think you're going to see that in AI. This is a company trading at 10 times EV to EBITDA with a brilliant balance sheet, unique asset. So yes, I think that could happen. That's what keeps the stock from going up in a straight line, but I don't think it's a material risk at all.
Slightly different risk. Nukes, very, very difficult to build, to put it lightly. It would take decades, not years, probably decades. What about the risk of everyone sees this coming, right? Or at this point, I think most people see it coming. You can go hop on, I think it was the Kinder Morgan call where they were making the case for natural gas demand growing up because of everything you're talking about. And you mentioned it briefly, but it's not just AI. Electrification of vehicles are coming at some point.
Yep.
Reindustrialization, forget electrification of vehicles, electrification of everything in the home. Like all of this is coming. What if is there some risk of nat gas build out, right? Like nat gas is the way a lot of our homes are supplied. Just I guess it would take a lot more competency in the regulatory body than I think is possible. But could you just see nat gas come to the rescue? We build, 100 nat gas baseload plants, and that kind of foretells the rise in power prices that you're talking about.
In a half a dozen years, a decade maybe. But I mean, where are you based, Andrew? You're based in New York, right? Yeah, so we both know what's happened in New York. They shut down Indian Point, then they won't let them build the damn pipelines. As long as there is a Democratic Party in this country, and that Democratic Party has any influence or control over any energy regulatory impact, you're not going to see it. Now, I will tell you what will happen, in my opinion, because we're seeing it now with Nuke. I think this power crisis hits. I think it hits. Again, which summer? I don't know. Okay, it could this summer. I believe you will see what you just said happen. I think you will see the Democratic Party, the centrist portion, basically say, okay, here's my options. We can fight climate change, or people can have their lights on. And when that vote comes down, I think they're going to go for the damn lights on. You see the build out of gas, but even that's going to take, and again, I get back to my transmission thing. Yeah, the damn transmission line takes 3 years. This thing, this is a crazy setup, man. Like you rarely see things like this.
I've got an article I need to finish, and I'll probably try to publish it around when we get this podcast out. But I'm with you. The moment you start having consumers have brownouts because of this, you're going to see a regulatory response, and it's going to be politicians know, right? One of the few inviolable rules is if the lights start going out, all the politicians get fired. The moment you start seeing lights start going out, you're going to see politicians saying, hey, bring the coal plants back online. Forget about it. And, coal plants are probably interesting. I don't know any publicly traded ways. Some publicly traded plants have coal plants. Coal to nat gas conversions, I think they've already been happening, but that's a natural to me. I think you could have a lot there. But if we start seeing brownouts, every single thing it's going to be open the floodgates. All right, let me talk about the 2 last big risks we have. You mentioned it earlier, but I've done bankruptcy before. You've done bankruptcy report, right? There are ways to bias the process one way or another, but it does strike me that Talon emerged at a less than $5 billion valuation, if I'm remembering correctly, roughly $5 billion. We can say $5 billion just to make the math easy. Today, they're $7 billion, and they're probably going higher, right? When you're in the bankruptcy process, everybody gets a shot. And it does just strike me, now things have gotten hotter, the demand, everything we're talking about, but CEG, everyone thinks they're going to buy them. And CEG had a chance to buy these guys for about $5 billion 12 months ago, and they didn't. And I understand the bankruptcy process could be biased, but if CEG had gone to the bankruptcy judge and said, here's $5 billion in cash, $5 billion in cash, pay off every creditor, everything, fully financed, we're a huge company, investment grade. They didn't pursue that. Now, there could have been any reasons, but one of the sticking points.
I'll tell you the reason. I'll tell you because that's just not the way that corporate boards work, especially on utilities. They would rather have it go public, get cleaned up, get uplisted, and pay double than go through all the mess. If I was on the board of and Constellation, while it's a rocket ship, is and by the way, I don't know that Constellation is going to be the buyer, because I think Constellation, the board, the same conservatism that caused Constellation to not buy Talon a year ago is the same conservatism that's going to lead them to look at it and say, oh, well, I can't buy it. It just doubled. But there's going to be someone out there that's going to do it, that's going to figure it out. So it's just, if you understand how boards work, they want clean, they want simplicity. They're not in the Constellation's not in the business of buying bankrupt IPPs with data centers and lawsuits. And that's not their thing. And if I was on that board, well, I would be a very different kind of board member. But I bet you the board just said, you know what, maybe, but it's just too complicated. Let's just wait.
Having dealt with some boards, you and I would get fired because, Buffett once said, hey, people asked him why he voted for, I think it was a Coke pay package. And he said, you can't be the person who burps in the boardroom too many times. And I know for a fact, and I think you would have the same issue. We'd burp in the boardroom and they'd be like, all right, this guy's got to go, right? We're here to collect $200,000 a year and work 12 days a year. These guys they're asking hard questions. It's too much. Just on a year ago, I think I agree with you. And this comes back to the M&A risk of Talon doing M&A. A year ago, Talon had, as you said, the data centers. They had the ERCOT assets. Those are gone now. So Talon, if you think about it, they've been putting themselves into a cleaner package, a cleaner bow. And whether that's a cleaner bow to go public and be the premier, hey, we are basically only a clean nuclear plant, or it's to sell to Talon, Vistra, whoever, hey, just buy this clean, unregulated nuclear plant. One or the other, but they've been setting themselves up for a clean breath. Last risk I want to ask you.
But can I tell you, if I was on the board of Talon, you know what I would say? This is what I would say. It's real easy. Guys, we're going to throw off $1 billion to $1.5 billion of free cash flow a year. We got $6 billion of market cap. Let's just buy the whole fucking thing back.
And utility Vistra has basically gone out and done that, if I remember correctly. I haven't looked at them in a while, but I mean, last year they were a very popular value investor stock. I think they probably still are, and they've done incredibly, and they were just buying back stocks. Now they've been really helped by all the power supply demand dynamics you talk about. But let me ask you the last risk.
By the way, I'm looking at Vistra. Just sorry to interrupt. Vistra just went. Yeah, they did go from 500 million shares in 2018 to 349 million shares at the most recent report. So they bought back 30% of the shares. That's what I think. That's what I think. That if I was on the board, it's very simple. We got a simple business. Let's not fuck it up. Let's buy back a ton of stock. The stock goes to the moon, and if someone wants to come in and offer us double, then we'll get to the moon quicker. And that's it.
The last risk, and this is actually, I think, the largest risk here. These guys have all been transformed. The nukes, especially CG and Talon, have been transformed by, as you mentioned earlier, the IRA with the PTC downside protection, right? And read Talon's Q1 earnings, and they talk about it. Hey, we're asymmetric because power prices go down $10 and we start getting that PTC floor prices. Power prices go up $10, and we're basically, there's things in the PTC, but we're basically uncapped upside. There's a decent chance there's a change of administration over the next year. And I could imagine, I don't think so, but I could imagine a new administration comes in and says, F it, we're going to burn the entire IRA to the ground, and we're going to take away those PTC payments. And if that happens, the downside, a lot of that downside protection goes away, as well as some of the earnings and stuff, right? So go ahead. You see where I'm going.
Politically, though, I understand exactly what you're saying. Politically, let's talk about Trump versus Biden. Trump had, as president, was a very rational economic actor. He made rational economic decisions, and he certainly did not do what, unfortunately, the Biden administration has done, which is basically start with, okay, anything Trump did, we're going to undo. I'm just, this is my view of things. I think they're both terrible. Let me just be clear. But when you look factually, the Biden administration came in and took everything Trump did and said, let's do the opposite. The Trump administration didn't do that with the Obama stuff. In fact, they kept some of it. They did this. So I hear you. I think it's more likely to go the other way. I think it's more likely if, the Biden administration's already, I think both parties, what I'd like to see is, the money that they're putting into semiconductors put into nukes. France did it. Canada did it with hydro. China's doing it. Why you want to win an election when we get brownouts and blackouts? We're going to build all these nukes. And
the only issue with that is, as we mentioned, like nuke, even if you were clearing the regulatory tape hurdles, right? if we just took away all the red tape, it would still take 5 years to get a nuke online. And I think I'm being
decade.
generous. Oh, I'm saying we make a national moon. I guess if you were like moonshot, you could get it. But I'm being really generous. If we said we know this is a problem, 5 years. Like, you don't solve the brownout and blackout problem in 5 years. Like, you have to start 5 years ago to solve the brownout and blackout problem.
But there is, I'm going to say this, and this is a very serious thing here. I do think there's a 1% chance that we see the World War II or power crisis kind of thing. Does that make sense to you? That it gets so bad that we say we've got to do a Marshall Plan.
That's exactly what I was referring to in clearing the red tape. Yeah.
I think that, I don't know. Like, look, it's headed in that direction, whether it tips over. But if it tips over, as bad as it can be, they'll get through it. I mean, we ultimately, America, I think it was a misquote to Winston Churchill, but said that, democracy is the worst system, except that's better, or whatever. America gets it right eventually by doing everything wrong first or something like that. I don't know. I'm butchering the quote. My point is, when push comes to shove, I think the right decisions are made. And by the way, look at the Inflation Reduction Act and the $10 tax subsidy to nukes. If I would have told you that the Biden administration, which has pushed as hard left as any administration in the history of the country, would go out and put a $10 floor under nukes, you'd be like, what the hell are you talking about? And they did it, and they're going to renew it. So, I think it gets there. But let's come back to one thing. I don't care about any of it. Buy Talon. It's going up a lot.
People can listen to the disclaimer there. Like all the best investors, Fundamental Edge believes that the learning process never truly ends. That's why the Analyst Academy is just the beginning of their journey with you. Fundamental Edge alumni gain access to exclusive content, such as the guest speaker series, which recently featured Rich Falk-Wallace of Arcana, who discussed the role of factors in fundamental investing. Alumni can also look forward to frequent webinars, case studies, and content from industry partners. Fundamental Edge recently hosted its first Analyst Spring Training Conference in Scottsdale, Arizona. Attendees enjoyed a range of speakers, judged a stock pick competition, and networked with fellow alumni. Mark your calendars for the spring of 2025 for the next conference. Visit fundamentedge.com/YAVP or just see a link in the show notes for more information about the next Academy cohort. Just one last thing, because I do want to mention the one other thing that I don't think it's a risk, because it's been around for a while and it's never been successfully implemented. But we live in a very connected, very smart society. And the one thing that people have always talked about is demand response, right? And you could see it does not take, you saw this in Europe over, summer of 2022. It does not take much of a demand response to really lower the energy usage of the grid. Now, a lot of the energy usage is coming from AI, where it's very, AI, one of the things with it is, in my dumb mind, I was like, oh, you shut down the AI from 5 to 6 o'clock when everybody's got their AC on. That's not how AI works. It has to run 24/7. So it's very hard to do demand response with that, though maybe you could. But you could imagine in a connected society with connected thermometers, like maybe you make a push. Hey, the government's going to pay for everyone to get a connected AC, and it's automatically going to adjust when the grid's hot or when, no one's home. It's automatically going to adjust your AC from 73 to 74. And that small change, it actually makes a mammoth difference. I don't think that's not a risk per se to Talon. It is probably a risk to the Super Bowl, like prices go parabolic because the grid is just always over demand. Go ahead.
I'll say two things.
Gotta quit smoking.
Yeah, no, I've never had a cigarette in my life, by the way.
I'm the same. One of the reasons I've had some interesting tobacco pitches recently, and I think one of the hurdles I have is I've never done tobacco, I've never done dip or anything. So when I look at these guys, I'm like, do people really do that? Yeah.
I'll smoke a cigar, but I actually haven't even had a cigar in years. I was traveling for 37 days. I got back to Connecticut and all the trees are exploding and it kicked my ass. I'll say two things. The chances of them actually getting that through government policy are just about the same as them building 50 nukes. The other thing is I wouldn't extrapolate Europe, in particular Germany, that experience. Germany is a very highly industrialized economy that depends a tremendous amount, not on consumption, but industrialization. So Germany's ability to drive their power consumption down had very much to do with the nature of the German economy. So yes, there are things that can play, but I'm going to go the other side for you. Go look at natural gas prices in Germany when the invasion happened. I mean, they went to the moon, asymptotic. Okay. These things go asymptotic. And when this happens, Like, I don't want to say these are meme stocks or something like that, although the chart looks like a meme stock, but I don't know. The upside is, I saw it before. I saw it with Montana Power and Light. I saw it with PPL. I saw it with, Southern Company. I was looking at the chart of Southern Company back then, Exelon at the time. We've seen this before. It's just taken 20 years. And remember, let's just stick with PPL. This is the last thing I'm going to say. Stick with PPL. PPL went from 10 to 50. Talon just went from 50 to 100. That means that it can go up 3 more fold. The numbers support it. We know that the stock market supports it, and there's nothing else like it. Once this gets uplisted and all that, again, the biggest shame about Talon is I don't think we're going to see any of that upside because someone's going to buy it.
It is funny, every time I have somebody and I'm talking to them, they're like, the stock's at 20, and my biggest worry is the largest shareholder does a take under at 30. And I'm always like, if I bought a stock at 20 and they got bought for 30, there are worse problems in the world to have. If you started recommending this at 60 and it got bought for 150, I hear you. You see the very bright future so clearly. And again, the crazy thing here is you run this forward to next year, and you could easily see them doing 400, 500 million in free cash flow to equity. And you start thinking, hey, these guys are going to be, even if they're buying back shares, they're going to be 1x leverage. They say they want to get to 3.5. You start doing the equity return math on paying that out plus leveraging this thing up, and you're like, oh my God. But Enrique, this was fantastic. We're going to have you on for another one the next time you've got a conviction name that's as interesting as Talon. But I do just want to remind everyone, because we talked hugely bullish numbers. I'm just going to remind everyone, OTC traded doesn't mean Enrique, he's obviously done great work here. This is a very popular, but OTC traded, increased risk, all that work. Please consult a financial advisor, do that, everything. I'm going to include a link in the show notes to Enrique's write-up on Talon. Can you just send me an updated one so I make sure I'm linking everyone to the right one?
Yeah, we actually, I update the one that's up there. I update it, and we're going to put out a separate note. So if you subscribe to daily.hxresearch.net, it's my free daily. On the website, there's the original note with a couple updates. On Friday or early next week, I'm going to do a note on the power crisis, the power cycle. Let me also give another disclosure. I don't own the stock. I don't allow myself to own any of the stocks that we have active recommendations on. So, that can go both ways. Some people are like, oh, you don't have skin in the game. My view is, I want to I make my money not by trading stocks. I make my money by giving great ideas to my readers. And so, I want to focus on that. I don't want any conflicts of interest there. So, I have no conflict of interest here other than me wanting to find kick-ass stocks for y'all to make money.
Perfect. Cool. Well, again, this was fantastic. Talon Energy, TLNE. There'll be a link to Enrique's write-up in the show notes, and looking forward to having you on for another round.
And hopefully I'll be less allergies next time. So
a quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.